Welcome to Allan Reports TV. I'm your host, Allan Labucan from allanberryreports.com. Today we have a new installment of our market commentary show. We'll be talking about some of the trends that we're following in the markets. Before getting started, I always like to start out with some thank yous. First of all, we have to, as usual, we use Ustream.tv and YouTube.com to record our shows, broadcast our shows, and they're really instrumental in us being able to bring these shows to you. So, if you're looking for a way to do online shows, those are two great websites with really easy to use platforms that make it for everybody to be able to do a show. So we highly recommend them. In addition, we always have to thank our banner sponsors. If you're watching the show on our website, you'll notice on the left and right there we have banner sponsors. Those companies make us able to be able to bring these shows to you. So if you are interested in any of those companies, just click on their banner and it'll take you to their websites where you can do your own homework on those companies. And of course, we always like to thank our viewers. Without you, we wouldn't have a need to do a show, and we thank you very much for tuning in to watch the shows. So today we're going to start our market commentary talking about the US dollar trend. It's been in a long-term bearish market for several years. Earlier this year, it had got a bit of a rally going. A lot of that had to do with the concerns for sovereign debt crisis over in Europe that caused people to get out of the euro and move into the dollar. That trade got pretty overdone in the first half of the year. Lately, we've been seeing a resumption of the bearish trend. With the fundamentals so poor, running up at record deficits. Forecasts are for several years of over $1 trillion deficits. This is also ballooning up the debt. In fact, if you look at things realistically, some of those countries that in Europe that were causing so much concern, the U.S. fundamentals are very similar when you look at deficit and debt to GDP ratios. And so we think that the bearish trend for the dollar long term is still intact. Any rallies are usually going to be, we expect going forward to see them fairly short-lived and then more downside. Next, we'll talk about the debt markets with regarding bonds and treasuries. They look to be in kind of a bubblish type of a situation and very overbought. Now there's a talk of a QE2, quantitative easing number 2, by the Federal Reserve, and I think it's more like quantitative manipulation of interest rates. We hear a lot about the economists talking about manipulation of currencies by China. We don't hear a lot about manipulation of the debt market by the Federal Reserve, and that's exactly what we see happening. The rationale is that they're doing this to help the economy. Low rates don't really do much if banks don't lend money. Consumers and companies don't need more liquidity. There's plenty of cash on the sidelines with both consumers and corporations. What needs to happen is that they need to be less fearful. And every time you turn on the television and you hear every economist from the Fed and all kinds of politicians talking about all the negatives and all the reasons to be fearful, well, guess what's going to happen? Companies and individuals are going to sit on their money. And sometimes I think that these politicians and economists at the Federal Reserve are more trying to make their themselves seem important by creating all this fear. Well, if we don't do this and we don't do that, there's going to be more of this, more negative. The things are so bad, and all this kind of jibber jabber to get votes or creating a level of importance, self-importance by economists at the Fed, I think is feeding into the fear. And, there are signs that things are starting to improve in the U.S. economy. And but if everybody stays focused on that, the negativity, fear will continue, and it will continue to cause a problem. And really what needs to happen now is some confidence. So, if the politicians can start, and the Fed can start coming up with some, some positive things to talk about, like game plans of how we're going to start to move in the United States towards recovery, I think that would be a lot more helpful in getting consumers and companies to start spending money instead of sitting on it. So, in a nutshell, when it comes to U.S. dollar and debt, both of the debt and the U.S. dollar have abundant supply and suspect demand. There's not going to be any shortage of bonds into the future if you keep on running up trillion-dollar deficits and keep on boosting the debt of the country up so dramatically. There also isn't going to be a shortage of U.S. dollars when you're pumping that out to try and stimulate the economy. So on the other hand, you look at commodities with soft supply and strong demand. And, at the end of the day, investors are much better off avoiding assets with strong supply and soft demand and focusing on assets with soft supply and strong demand. And there is your perfect difference between the U.S. dollar and U.S. debt and commodities. What happens in the short term, one never knows. But in the long term, I think that commodities are going to be a much better place to have your money than because of the fundamentals of supply and demand compared to U.S. dollar and U.S. debt with poor fundamentals. So now we'll move into commodities. First, we'll talk about gold. Gold has been on a 10-year plus bullish trend that started after about a 20-year bearish trend for gold, and during that time of the bearish trend for much of the 80s and 90s, there was a severe underinvestment in exploration to find new deposits, and now we've got a situation where the supply chain is very weakened, even though we're getting very strong demand. I often hear commentators talking in the media about what's moving gold or other commodities. And, a lot of that talk is about, well, it's because of buying, because of currency concerns or economic concerns or political turmoil or a vast array of reasons. But I don't hear a lot of talk about the supply chain, and I really think that is the crux of the story. If you had all of those reasons why people are buying gold and other commodities, and you had strong supply, the price would not be reacting the way it is. That's the bottom line. You want to know what's going to happen with commodities, follow the supply chain. Yes, demand is important as well, but at the end of the day, if you got strong reasons to have demand and strong supply, that price isn't going to go very far. On the other hand, if you have strong demand and weak supply, the prices go up. We've seen it in commodities for the last 10 years. Nothing has really changed on the supply chain, so we expect to see that continue for many years into the future. And so short term, we could, gold and silver, copper, oil have all moved up quite aggressively as the dollar has been doing the opposite. We could catch a little bit of a rally in the dollar and some weakness short term in commodity prices. But when you're in a strong, fundamentally based trend for a lot of years, what generally happens is in a bull market, the pullbacks are short, don't last very long, and the resumption of the bullish trend continues. And that's what we see happening for many commodities. Silver is much like gold. In fact, we think it's more bullish. It's been outperforming this year. We think it will continue to do that. We're really bullish on silver. Oil and copper, those are our key economic indicators for the health of the global economy, and they're definitely indicating that the global economic recovery is in very sound shape. The global economy is doing a whole lot better in the recovery than the American economy. We think that there's signs that the American economy could start to join the party a little bit more, but even in the interim, things are going very well for the recovery of the global economy. Next, we're going to move into stocks. We'll start with the big cap stocks that trade on the New York Stock Exchange and are part of the Dow Jones Industrial Average and the S&P 500. Earlier this year in our Outlook 2010, we talked about our prediction that these stocks would be in a trading range for the Dow somewhere between 11,000 points and 9,000 points. Right now, that and the S&P in a similar type sideways trend, and that's where we are. We're trending sideways right now. The stocks are trading at the top end of the trading range. We expect them to start seeing some pullbacks, and not severe pullbacks or any kind of massive sell-off, but getting it back into towards the lower end of the trading range, and then it can rally towards the end of the year. And so that's what we're seeing for stocks in general. Now, we also follow the Toronto Stock Exchange very closely. It is in very the bullish trend for that is in very solid shape. The reason for that is that the Toronto Stock Exchange, got my co-host here, Jackie, trying to get into the picture. He's a bit of he likes to be part of it as well, so he's laying down now. That's my dog, Jackie Legs. Getting back to the TSX, it's in very sound shape. We think that with our bullish outlook for commodities, that it will continue that bullish trend for the remainder of this year. The Toronto Stock Exchange venture market is where a lot of the smaller companies trade in the resource sector. The fact that that's not trading in some kind of foolish optimism. The strength is pretty concentrated into high quality companies in that space, and we think that this is very bullish sign that the commodities are not in any kind of bubble right now. If you are going to see a bubble, what will happen is every mining stock will be trading like gangbusters, regardless of whether they have anything in the ground or not. If they just have a claim, and it'll be kind of like what happened with the tech stocks in the 1990s. They were all trading up at nosebleed levels, regardless of the fundamentals. Until we see that, we don't see a bubble forming in the resource stock. So we think that there's more of that to come. So that's a wrap on our market commentary today. Before closing, we'd like to stress that this show and our reports are for information purposes only. We aren't making buying or selling recommendations. It's important for you to do your own homework and research before and speak with your financial advisors before making any investment decisions. We're always trying to grow our audience. If you can help us out by sending an email to your friends that follow the markets, we'd really appreciate that. We also really appreciate you taking the time to watch the show. We know that everybody is very busy these days, and we strive to produce a show that saves you time and brings you helpful, high-quality information. Our next show will be Tuesday of next week. We'll be having another In the News segment, and we'll be talking about some resource companies that have recently had news out on developments at their projects. We hope you can join us for that. One of the best ways to keep track of what we're doing is to subscribe to our email above there. And again, you can find all of our work on our website at allanberryreports.com. We'll see you soon. Have a great day.